With the calendar rapidly moving toward the middle of May, many investors have seen 2023 equity portfolio gains, especially for the widely followed large company S&P 500 index, which year to date through May 10th of this year was up about 7.8% on a price basis, which doesn't include dividends. However, equity market gains have narrowed since the end of January, and as fewer stocks participate in the rally, additional equity gains through the end of the year could be limited. So I wanted to mention a few of those narrowing factors. After a January gain of 6.2%, the S&P 500 since the end of January has increased about 1.5%. Just 3 of the S&P 500's 11 sectors using the Global Industry Classification Standards, or GICS, has increased by more than that 1.5% rally since the end of January. So 8 sectors have changed less than the index, and 6 of those have moved lower. The S&P 500 is a market cap weighted index, meaning that the largest companies have a disproportionate contribution to the value of the returns, and the S&P 500 equal weight index, which weights all 500 companies equally, has declined about 6.3% since the end of January. So this means that the average stock in the S&P 500 is lower over that period. Also, the widely followed small company Russell 2000 index is down 8.9% since the end of January, another indication of low participation in the rally. And then finally, we'll look at the S&P Bank Select Index, an equal weight index of 95 financial institutions. It's declined 32.8% since the end of January, an indication that investors see ongoing risk in the banking sector. We attribute equity market gains this year to healthy consumer spending in the U.S., but we believe that the narrowing of leadership in the equity markets suggests that investors see the potential for economic data to slow from solid first quarter levels. But we caution against chasing the rally at the current time. Don't focus only on what's working and those stocks, but rather focus on high quality companies and building portfolios that are diversified across sectors, and that'll help to build long-term success and can also provide a great balance for markets that are expected to remain volatile. And to reiterate what we've discussed in prior commentaries, rebalance portfolios as needed so you can trim positions that have become overweight relative to portfolio goals and add to positions that have lagged and are now underweight. For specific recommendations and strategies, please contact your D.A. Davidson financial professional.